Hey, welcome to Propcoach. DSR is a calculation tool used by the banks to see if you can repay back your loan. Okay, see you. Bye-bye.
Today I'm going to explain you the first jargon, and the first jargon means subscribe. And subscribe means that if you don't push the subscribe button, I'm going to get very sad. Okay, today we're going to talk about the DSR, the Debt Service Ratio. Super important term for you to know as a real estate professional, but actually for anybody that wants to actually buy real estate somewhere now or in the future, because banks use a tool to actually see if they want to give you a mortgage. And that tool is called the DSR, the Debt Service Ratio. The DSR is simply a calculation by the bank to see if you can repay back your loan. So of course, a mortgage is a home loan, a property loan. And it takes a couple of years, can be 20, 25, 30, 35 years. And the bank, of course, wants to know, can you pay me back that loan? And obviously, how do they know if you can pay back that loan? They want to see if you have enough funds to pay back that loan. So like I said, you every month get a certain income. It can be your salary, can be other rental income, can be commissions. Whatever income you have, the bank wants to know if it's sufficient enough for you to basically repay any loan that they want to give for you for a mortgage. But based on the salary that you're getting, of course you already have certain commitments. There's already certain payments that you have to make every month. So they want to know on your net income if you can repay back that loan. Because if you already have like a car loan, if you have like another mortgage, if you have a personal loan or any other loan like credit cards or anything else, the bank wants to know which other commitments do you have. And then the DSR becomes a super simple calculation. What they simply do is the following. They basically take your commitment, they divide it by your total income, and they do that times 100. And whatever number comes out there is basically your DSR ratio. And the DSR ratio is an important number for the bank to look at to see as a first, will they be able to give you a loan? Now, every single bank has a different debt service ratio. So if your DSR is within the limit of the bank's ratio, you stand a higher chance to actually get that loan. It doesn't confirm that you get the loan because there's still a few other factors that the bank will look at, but it's definitely the first thing that they will look at. So the healthier your DSR or the lower your DSR, the better it is for the bank to consider the loan. Every single bank has a different ratio. You have to check with the bank what the ratio is, and sometimes they also change those ratios. Some banks have 50% ratio, 60%, 70%, whatever the bank's ratio, check before you submit your pay slips and your commitments, because you can already know for yourself if you stand a high chance to actually get this mortgage. That is all what I want to explain to you today about the DSR, the Debt Service Ratio. Now that you know, use it in your advantage to advise your clients, or if you're going to buy your own property, make sure that your debt service ratio looks really good. Thanks so much for watching this time. I hope I explained it to you very well. Do leave me a comment in the comment box if you need more explanation or you want me to explain any other jargon in the real estate market. But for now, I just want to thank you for joining me today, and I will see you again next time. Bye-bye.